Silver did not announce its move. It did not rush higher with noise or panic. It moved calmly, deliberately, to $94.14. No alarms went off. No crisis was declared. Yet beneath this quiet rise, pressure began to form. Markets do not behave this way by accident. When an asset climbs steadily without excitement, it usually means decisions are being made away from public attention. This is how positioning looks before narratives change, because the real danger in markets is not chaos. It is calm, just before adjustment. What matters is not that silver reached this level. What matters is why it was allowed to do so quietly, and what happens when this hidden pressure finally demands release. Welcome to Boring Currency Registry, a place for those who value clarity over noise. If you've seen cycles come and go and still believe patience matters, consider subscribing. And let us know in the comments, from where are you watching this unfold? Silver's move to $94.14 was not a headline event. It was a signal. Since the beginning of the year, the metal had already gained more than 30%. Such performance usually attracts attention, but this time it unfolded with little public discussion. That silence itself was meaningful. Markets often reveal their most important messages when few are listening. Rapid, emotional rallies are easy to spot. Quiet, steady advances are harder to interpret, but they are often more important. They suggest adjustment rather than speculation. Silver did not behave like a trade driven by excitement. There was no rush of retail participation, no sudden spikes in volume, and no dramatic reversals. Instead, buyers absorbed supply consistently. This pattern pointed to long-term participants responding to structural conditions, not short-term price movements. Silver occupies a unique position. It is both a monetary metal and an industrial input. Because of this, it reacts early to changes in confidence, liquidity, and real-world demand. When it rises during relatively calm market conditions, it often reflects preparation rather than fear. At this stage, silver was not predicting collapse. It was signaling imbalance. It suggested that confidence in current stability was being quietly hedged. History shows that such signals tend to appear before broader adjustments become visible. The price was not the story, the behavior was. While most observers focused on silver's price reaching $94.14, experienced analysts looked elsewhere. They turned their attention to the gold-silver ratio, a quieter measure that often reveals stress long before price charts do. This ratio does not track excitement, it tracks imbalance. And at this moment, it was sending a clear signal. The ratio had fallen to 51.33. On the surface, this number meant little to casual market participants. To those who study long-term cycles, it meant a great deal. For much of the 2023 to 2025 period, the ratio stayed above 80, sometimes even higher. During those years, silver was widely seen as undervalued compared to gold. Capital favored gold for safety, while silver lagged behind. That relationship had now shifted sharply. A falling gold-silver ratio does not automatically mean silver is strong. It often means the market is reallocating risk. Silver tends to outperform gold when participants believe inflation risk, industrial demand, or monetary uncertainty is rising. Gold, by contrast, performs best when fear is obvious and defensive positioning is extreme. The current ratio suggested something more subtle was happening. Markets were not panicking, they were adjusting. This distinction matters. When silver outperforms gold quietly, it often reflects pressure building within the real economy rather than fear within financial markets. Industrial demand, supply constraints, and currency expectations all influence this ratio. When they align, silver moves first. At 51.33, the ratio is approaching levels that, historically, have not lasted long. Either silver consolidates and the ratio rises again, or gold begins to catch up. Both outcomes involve change. Stability at these levels is rare. What concerned analysts most was not the absolute level of the ratio, but the speed of the decline. Rapid compression suggests capital is repositioning quickly, often in response to information not yet visible in public data. Institutions rarely wait for confirmation. They act on probability. For business leaders and entrepreneurs, this signal should not be ignored. Ratios like this often shift before broader cost pressures emerge. They hint at future volatility in inputs, currencies, and financing conditions. The gold-silver ratio was not predicting a crisis. It was warning that balance was becoming fragile. And fragile systems do not need shocks to change direction. They only need time. Silver's rise cannot be understood through financial markets alone. Unlike many assets that trade purely on expectation, silver is anchored in the physical economy. Beneath every price chart lies a network of factories, supply chains, and production lines that depend on this metal in ways that cannot be easily replaced. This industrial role is what gives silver its quiet strength. In recent years, industrial demand has shifted from being a supporting factor to becoming a central driver. Silver is essential in electronics, energy transmission, and advanced manufacturing. Most notably, its use in solar panels and electric vehicles has expanded rapidly. These sectors are not speculative. They are policy-backed, capital-intensive, and long-term in nature. Once demand emerges from these industries, it does not disappear quickly. Reports from major economies confirm that industrial silver consumption grew by roughly 15% over the past year. This growth did not come from one country or one sector. It emerged across the United States, China, and India, each driven by different priorities but arriving at the same conclusion: silver is necessary. Substitution is limited, and efficiency gains cannot eliminate demand. What makes this cycle different from past rallies is the absence of excess supply. Mining output has not increased at the same pace as demand. New projects take years to develop, and rising energy and labor costs limit rapid expansion. Unlike financial assets, silver cannot be created through policy decisions or balance sheet expansion. This creates a structural floor under prices. Even when financial demand fluctuates, industrial consumption continues. Factories do not stop production because of market volatility. Contracts are honored, supply chains are maintained, and physical metal is consumed regardless of sentiment. This foundation separates the current environment from speculative episodes like 2011, when prices were driven largely by leverage and momentum. Today's demand is embedded in real output. That does not eliminate risk, but it changes its nature. For decision makers, this matters deeply. Rising input costs rarely announce themselves. They accumulate quietly before appearing suddenly in margins and pricing power. Silver's industrial role means its price movements are early indicators of pressure forming within production systems. The market was not celebrating silver's rise. It was acknowledging necessity, and necessity, once established, tends to persist. Silver's steady rise has also been shaped by the global monetary environment. Over the last 18 months, central banks, led by the Federal Reserve, shifted toward easier policy. Interest rates began to fall, and liquidity slowly returned to the system. In such conditions, assets that do not generate yield, like silver, become more attractive by comparison. Lower rates reduce the cost of holding metals. They also signal that policymakers are concerned about growth or financial stability. Markets listen carefully to these signals. Even when rate cuts are gradual, they change expectations. Investors begin to question whether stability is being supported naturally or maintained through intervention. This uncertainty has increased volatility beneath the surface. While silver's price has moved calmly, options markets tell a different story. Implied volatility has remained elevated, suggesting that traders expect larger moves ahead. This disconnect between calm prices and anxious positioning is often a warning sign. Professional participants respond to such environments by defining risk, not ignoring it. Rather than taking large, unprotected positions, they use structured strategies to limit downside while maintaining exposure. This behavior reflects caution, not fear. It shows awareness that trends driven by policy can reverse quickly if expectations change. Silver is particularly sensitive to shifts in central bank communication. A pause in rate cuts or even a hint of tightening can trigger sharp pullbacks. These moves often happen suddenly, leaving little time for adjustment. Markets that rise quietly can fall loudly. For business leaders and entrepreneurs, the lesson is not to avoid risk, but to respect it. Monetary policy affects financing costs, currency stability, and input prices. When metals respond early, they are signaling that conditions may change faster than balance sheets can adapt. At 94.14, silver was not demanding action, it was demanding attention. Quiet markets encourage complacency, but history shows that complacency is costly. The current environment rewards preparation over reaction. The pressure building in silver reflects a system leaning on policy for balance. Such systems remain stable until they don't.